Hi, were you one of the many people who thought you would be seeing 5% mortgage rates before the summer? Well, unfortunately, it's time to think again. If you didn't hear, or wondered why your 401k took a big hit this week, we got some new CPI data and it didn't look as good as we were hoping and the market was assuming. But what is CPI? CPI, or Consumer Price Index, scrutinizes the weighted average of prices for a collection of consumer goods and services, items like transportation, food, and medical care. It's widely recognized as one of the most dependable statistical indicators pinpointing periods of inflation or deflation. In the data released on February 13, 2024, by the U.S. Bureau of Labor Statistics, there was an increasing inflation trend, something that has been on a rise for the past few months. The Barron's report provides a deeper insight into this trend and gives a more comprehensive understanding of the economic climate. So, considering the latest data on January's CPI inflation, how does this affect you? Quite simply, as inflation continues its upward trajectory, every dollar in your pocket becomes less potent. It buys a minutely smaller portion of a product or service you need. The buying strength of your dollar dwindles, and the cost of living experiences a corresponding rise. In essence, your money doesn't stretch as far as it once did. Now let's delve into the cancellation of rate drops. Interest rates have a profound influence on inflation. Customarily, as economies overheat, central banks elevate interest rates to moderate this overheating. Conversely, economies undergo downturns, rates are slashed to catalyze spending and investment. The current decision to cancel anticipated rate drops, as described in the Barron's article, is undoubtedly a reaction to the surging inflation figures reported this January. By maintaining a stance on interest rates, institutions like the Federal Reserve aim to decelerate the economy and, in the process, mitigate inflation. According to the latest information, the decision indeed has a mixed bag of implications. On one side of the coin, savers may potentially experience improved returns on their deposits, a positive development. However, flipping the coin reveals less pleasant consequences for borrowers, who could be looking at increased costs for loans and credit cards. The recently released U.S. CPI numbers illustrate an elevation in inflation, which directly led to the cancellation of rate drops. This decision, while it may provide an advantage for savers, might be disadvantageous to borrowers, painting a complex picture of its impact on the economy. Reflecting on the recent surge in consumer prices as reported in the data, it's evident that inflation is impacting everyday costs. Understanding these economic indicators and the actions of central banks can help you navigate these inflated times. So, the next time you feel the pinch when you buy your morning coffee or a new car, you'll have a better understanding of the forces driving these changes. Stay informed, stay ahead of the curve, and keep tabs on inflation reports like today's CPI data.